Welcome to the Big Mike Fund Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my good friend, Alistair McDonald. Hi, Alistair.
Hey, Mike, it is great to be back with you.
Thank you so much for joining. Really awesome to have you. And before we jump into business, any interesting updates with Alistair? Any news? Hopefully good news.
Well, there's always some strange messes that I'm making and puzzles that I'm interested in creating. So let's see the latest iterations. Goodness, so many. Son's graduating, heading out to college. So I'm about to become an empty nester on the personal front. That's a huge shift.
Congratulations.
Thank you. Yeah, he's actually going to be a rocket scientist. So he's not even joking. When he talks about astronautical engineering, my eyes just glaze over. So wonderful news there. It's a big shift for me. My nonprofit, we have just been received, as you know, Mike, but maybe our friends listening don't. I run an international counter wildlife trafficking operation, and we protect elephant in high risk areas of social conflict and civil war and so forth in West and Central Africa. And we have just received a letter of engagement from probably, certainly in our opinion, the most qualified conservationist in the last 100 years, which is the Jane Goodall Foundation. So big achievement for us, a huge feather in our cap in terms of legitimacy and credibility. We're just a scrappy, bootstrap guerrilla type operator, and this has just been profound. We've also just received the entire contract for the largest national park in Africa. It's the size almost of France. From WWF Germany. So that is in the Congo Basin called Salonga. That's really exciting. Dental practices, as you know, my vet hospital exited recently, and my dental practices in Toronto, we're looking to double the number of practices in the next 8 months. So a lot going on there.
Oh, well, that's a wow. That's a great update. Obviously, you got to be excited that as father to see your son putting the space shuttles, hopefully on the moon, or
hopefully they get off the launch pad.
Yeah, that's exciting, and obviously your great work. Thank you for your service to the conservation of I guess elephant habitat, right?
And the societies and communities that are at risk because of terrorism and so forth. It's complicated work, but I'm surrounded by people incredibly capable and hardworking. So lots to be thankful for.
Yeah, awesome to hear that. And congratulations on sales of the veterinary practice. And interesting to hear that you are expanding in Canada. Just very quickly, we're going to shift into the economic discussion and what's going on out there. But you still feel comfortable expanding your footprint of practices in Canada, even with some uncertainty that's out there today with the economic possible global recession on the horizon?
Yeah, and this actually fits beautifully into the macroeconomic outlook for the next several years. Certainly my outlook and that of individuals who will have their own distinctions of what they think. But one of the critical reasons that Canada has my and my partner's attention. Certainly I have incredible partners in Canada, but the shift in Canadian social pressures to increase the social welfare programs of health were inevitably going to shift into government. The Canadian government over the last 10 years has shifted pretty aggressively toward public-private solutions, whether it's in banking or startup financing or what have you. And part of that is our anticipation almost 2 years ago that we're going to see the same thing into the dental space. And that landed beautifully. About 5 or 6 weeks ago, Trudeau's government announced that a new initiative to, let's be quite frank, buy votes would be a government sponsorship of all dental care for those looking for, with incomes of less than 70,000 Canadian a year, and a good portion of those with incomes between 70 and 90,000. As always, those over 90, you pay your own way. But we are poised to be the solution provider. The particular business model that we have, we're perfectly poised to partner with them. So we want to get on the front side of that bureaucracy and see if we can align ourselves as a preferred partner. So that is the bigger picture, because the worse things get, the bigger government gets, historically speaking. Consider, for example, that there was no SEC until 1933, right, by which time the crisis had already hit, and government, created this giant Securities and Exchange Commission to put out a fire that had already run itself dead. So government tends to grow in times of crisis or economic contraction, and I've deliberately, with my partners, tried to position ourselves in a spot to actually profit from and gain from that instead of be on the other side. There's a lot more to it, but that's some of the thinking.
Well, that's amazing foresight to the opportunity. So you're setting yourself up for great success regardless of what happens, because you're fronting the opportunity that the government is going to write a lot of checks and spend a lot of money, which is phenomenal. And
in the area that is non-competitive, which is emergency dental care, I think that we've solved the reason why there's no emergency dental care. I've run a pilot program in the veterinary space, or been a part of one in the veterinary space, and took that model to my partnership with these incredible folks. We've been running a pilot practice now since 2017 with data of the margins on this particular model that have been really, really impressive, 2 to 3 times that of a standard dental practice. Wow. So without much of with a fraction of the overhead, that's really the key. Anyway, so the type of medicine of emergency care, we're not competing with anybody for that. So to position ourselves there as the government endorsed provider, I think we'll see. We still have to earn that endorsement, but we're poised to get it.
Good luck with that. And that's awesome to hear. So let's shift into a little bit more of economic discussion on what's happening here in the United States. Let's look at the broader picture. We're dealing with obviously substantially accelerated inflation. Not as bad as Zimbabwe, right? Not as bad as where you grew up with, you have to pay for your lunch before you order it, because it's going to be 20% later, 20% more by the time you're done.
Yeah.
But, the March number was 8.5. I believe the print came out today. We're recording this on May 11th for April, 8.3%. And that's the CPI. I think most people perceive the real inflation, if you add food and energy, is to be somewhere in the 15% plus. And I don't know what the exact figure, but that reported inflation feels understated. We're not going to jump into that. So are we going to be decelerating the inflation with rising interest rates? And the Fed has just turned very aggressive. And you've talked about this great concept in the past that the Fed doesn't really lead, they follow. So they're following what's already been happening with a bond, 10-year treasury. But what are your thoughts on what's happening? Is this going to be too fast, too aggressive? Is it going to put us in a recession? Is it really going to decelerate inflation? This is a weird inflation. This is driven by supply chain problems, not necessarily by Fed action. So the floor is open.
Yeah, and I think that one of the reasons that despite a number of initiatives by the government over the last X period of time, really going back to the collapse of long-term capital management, the efforts to support the economy have really been efforts to support the market. And there's a huge difference between the two. The difference, and in every case, whether it was long-term capital management or the tech bubble bursting or the housing bubble bursting, the Fed showed up with those same two tools that they have, which is lowering interest rates and increasing the amount of credit available to a select group of finance companies. Those are really the only tools that they have. And on every occasion, we've had individuals coming out and saying, "Oh, inflation is coming, inflation," and it did not happen, and it didn't happen for decades. Where was the inflation that we saw? Instead, inflation in asset prices instead of cost of goods. So what's different this time around? I agree with you. Certainly, supply chain disruptions are a huge factor, which, like commodity markets, tend to be self-correcting over time. In commodity markets, we say the cure for higher prices is high prices. As in, price of oil goes to 150, suddenly electric and wind and solar make sense. So the cure for high prices is high prices. The same is true with supply chain disruptions. The cure to supply chain disruptions is supply chain disruptions. Others figure out ways around them. Unfortunately, just on that point, I recently saw a heat map of the number of ships waiting to dock off the coast of China that are locked there because of their draconian COVID lockdowns. So
I
now
saw the
we've
same
got
picture.
phenomenal.
It's staggering how many ships just can't dock.
Yeah, just profound. And so now we're talking about not so much them getting to us, but them getting into even to resupply and bring us the widgets and flip-flops and things that apparently we can't stop buying. So that these are huge contributors, of course, to inflation. Historically speaking, supply chain inflationary cycles are just that. They're cycles. They are transient. They don't last they last, but they all end because the problem is its own solution. The reason that in my assessment, and I think the data supports my case, why is it that this time we have successfully engineered inflation? It was Bernanke who in 2010 said, "We will not allow inflation above 2%. And his literal quote was, "We can raise rates within 15 minutes if we need to." Now, Bernanke has long since, taken the rotating door into, I'm sure, overpriced consulting. He's not really relevant, but that perspective is, well, where are they now? It's just a phenomenal example of the Wizard of Oz, really having nowhere near the power everybody really needs to believe that they do. So the distinction this time is between why previous iterations of Fed-induced support manifested as asset inflation as opposed to cost consumer goods inflation is the transfer mechanism. We broke the mold when we started shipping checks to American households, and that bypassed the standard version that has worked ever since long-term capital management imploded. We could go back to the savings and loan crisis of the 80s, 90s there. Same mechanism, stepping in, create asset price inflation, higher home costs, higher bond markets, higher equity prices. So the transfer mechanism this time was different, which is a direct channel to your mailbox with actual money. And that immediately bled into a number of including, and Dave Rosenberg out of previously Gluskin Sheff, now Rosenberg Research, showed the data that I think it was from April of 2020 until August of 2021, US consumers forward consumed 8 years of durable goods. 8 years worth of goods in terms of Home Depot shopping and washer dryers. And so that monstrous gorging of consumer durables also compounded the supply chain issues. These are all transient. These are transient. Now, everybody is getting mocked for using that word, but if we pay attention to the mechanisms behind it, we'll see that they are transient. How many more 8-year forward consumptions can we gorge ourselves on? Not that many. How many more future pandemics can those coincide with? Lockdowns, shipping ports lockdown, etc. How many of these are transient phenomena? However, the durable, dangerous aspect of inflation this time around is this basically direct to consumer checks in the mail. That is sticky because, as you and I know, this brief study of history in any culture, once a society becomes accustomed to a certain benefit, it becomes an entitlement quicker than the check clears. So we've now bred a generation of, or almost a generation, we've certainly seeded a generation of expectation that whenever stuff goes bad, you'll get bailed out. Wall Street's been given this for decades, but for the first time, consumers were. And I think that is a very slippery slope, amongst other concerns.
That's very interesting. So let me just kind of dive a little bit and let's kind of dissect this further. So the government transferred trillions of dollars to the consumers directly in the form of various COVID help. And the consumers have taken the money and spent a good amount of it on durable goods and accelerated consumption by years out. And
meme stocks.
Yeah, and we're buying stocks and continue to push the capital markets higher and higher. Now, it feels like, at least for the time being, the government has lost its will, but the balance in Congress is such that it's unlikely that any major spending are going to be put forward. And the Fed, well, I guess it's the markets. The markets are fronting the Fed. The interest rates are rising. And it's a demand destruction, right? It's not going to necessarily correct the supply chain issues, but at least higher cost of financing and higher cost of goods is slowing the demand. So are we heading to a severe recession, a severe global recession? Because you got multiple concurrent headwinds, basically sort of evolving around all of us. We got the higher cost of debt service. We've got some level of demand destruction by the virtue of higher prices. People consume less as things cost more. And on the other side, the consumption has been fronted. So now, as consumers take a step back, they're likely to slow down the consumption quite a bit. So are we going to see a rapid shift from kind of a things are great to we are now in a recession and we have to tighten the belt and do other things?
I think that the answer, at least the approach, is let's assume yes, because that way the only thing we'll forego is temporary transient opportunities. Excuse me, and opportunities present themselves all the time. It is the avoidance of unnecessary risk right now, or uncompensated risk, that I think is the smartest strategy. The issue is things have worked so well for so long for so many people that we have, unfortunately, many of us, even considering, the GameStop type speculators, they've been rewarded for their speculation. And that's a terrible thing. It's a terrible thing for, and Charlie Munger makes this case, the Robin Hood and their ilk. It is a terrible thing for the long-term idea of value creation in an economy for a generation to think that this is the best way and to be rewarded for it. It really is immoral and unethical and dangerous to the long-term fabric of ambition. It perverts ambition, and that's what hot money does. It distorts timeframes and perverts incentives, and it's unfortunate. So I think the best answer is let's assume yes and be surprised with the positive outcome as opposed to the other way around. In fact, both Gary Schilling, who has perfectly forecast every one of the last 5 recessions going back to the late 70s, is saying that it is now upon us. Rosenberg makes the case, it is upon us. We are in it. The recession has begun. And the first quarter GDP, real GDP, coming in at minus 1.4%, is the first data point that we need. For us to turn it around here would be surprising. So I'm assuming yes, and personally acting in accordance with that.
Yeah, that makes sense. That's actually a great point. Technically, if the Q2 comes in as a negative GDP number, then we are in technical recession already. We've been in technical recession since, I guess, start of Q1. But it's almost bizarre because unemployment figures are still very, very low. So yes. You've got no full employment, low unemployment. You've got ravaging inflation, and sort of it feels like we're still doing well, and hiring is so hard. It's almost go find talent now. Yeah, you have to pay. It's a competitive environment, which is counterintuitive to a recession. During recession, you expect unemployment to grow, and we still haven't seen any of that.
Yeah, that's a really great point. I think what's critical to recall is that recessions are a process, not an event. And it's worth remembering that, and there's a number of easy examples that well, firstly, to frame it to your point about unemployment, unemployment is sitting at 3.6% right now. And we could make the case that this is really bullish and good news. But if we actually paid attention to history, we would notice that on every single occasion, going back to 1950, that unemployment has touched or fallen through 3.6%, a recession has followed. It is literally just a matter of time. In some cases, within 2 or 3 months, in others, within 8 or 9, in every single case. So it is not so much what got us here as what follows 3.6 unemployment that worries me. Honestly, it is at times like these, in the entrepreneurs that I work with, I have a private group, of course, that I work with. And when we get to the squeaking point where everybody is kind of just a joking term, but where everyone's squeaking about hard to find employees, which I understand, I'm experiencing the same. This is a problem that corrects itself. By the time it reaches the point where the type of entrepreneurs I'm working with, it's bumping up into their reality, it's worked its way through HR, through supplies, through all these things to where it's bothering them. This is usually an indicator of a turn being upon us. So I look at the historical precedent going back, in this case, 72 years. I look at my own anecdotal experience where people, by the time it reaches these level of entrepreneurs, it's usually rolling over. Much like commodity prices, this tends to be self-solving, essentially. But the other critical thing about it doesn't feel like it. When we think about the recession, the post-tech bubble recession, we point to the September 11th attacks and say that, and you will literally hear pundits and fund managers and so forth say, of course, when the planes hit the building, we went into recession. We had been in recession since March of that year, May of that year. The US had been in recession for many months, but we associate the event with what was actually a process. Fast forward to the financial crisis. Everybody remembers, when Lehman Brothers went bust, that's when we went, and it taking us into recession. Again, we had been in recession since March of 2008. So because the human brain is really not wired to remember or acknowledge processes, we bolt onto events and retroactively think. And I think that that's likely to be what's going on here. It didn't feel right in May, June, July, let's say August of 2008. I'm just using it as an example. It's not necessarily a like-to-like case study, but it was a month later. The event is now, now we're in trouble. We've been in trouble for some time.
Yeah, that's a great point. I guess we're seeing some leading indicators in this unemployment figure breaking below 3.6 is a leading indicator, and what follows is a mathematically likely scenario. So we just I guess going through the process of going into the recession. So there's a lot of data pointing that we are entering that, or we've already entered, just not enough. So what actions can folks take today to adjust their investing, their businesses? If you're trying to be a forward-looking leader, not responding to the past, more of a predicting the future. A prediction is hard, but it's not a prediction. It's more of what is likely going to happen. So what can people do? One of the most fundamental questions, it's funny, I've gotten this question, and you're going to laugh at this because the question itself is almost a ridiculous question. So I had some of our fund investors, some of the folks who've been with us for a long time, they have stock portfolios too, they're diversified. And my good friend asked me just a couple of days ago, should I sell? And if I do sell, where do I move the money? Because it feels like the pain is not over. Pain has already been there for a number of months, but the feeling is it might continue to be a lot more pain in the stock and bond markets. Again, if the rates rise, the bonds take it on the chin. If the interest rates rise, it hurts technology stocks and many leveraged companies with leveraged balance sheets. So the pain ain't over. And the stock market is not seeing stability, is not seeing confidence. So the sell-off is likely to continue. And the follow-up question: what do I do with the money? Where do I invest in? What am I? What is all assets are going to be shrinking? So they sit in cash in a high inflation environment. So what do you think?
I think it's an interesting phenomenon that is always historically early contractionary or late cycle phenomenon, the sense that I have to be putting my money to work, which is another way of saying I need to indiscriminately buy something. Because if we had discrimination, if we were discerning about what qualifies as a worthy investment, we would never be bothered waiting for good investment opportunities. So it is very much a late cycle, early contractionary instinct to feel compelled to quote unquote, do something. And I think it usually is indicative of somebody who lacks a level of qualitative analysis of what really qualifies to get your capital. If you've successfully built a large investment or savings over time, what qualifies for that money to be deployed? Put it in the S&P just because you should put it in the S&P. And this is where we abdicate the responsibility as shepherds of our own and our family's resources. So to me, the answer is what qualifies, not what should I do with it. It's what qualifies, so say, this is my risk profile. This is what I'm looking for, yield or growth or what have you. This is what historically has provided a good risk adjusted return. This is the risk premium willing to get paid or to pay. These are far, far more valuable mental models for us than what do I do with it. The irony is that at this time, the aversion to cash really makes it the most contrarian investment of all time. Because we'll say we've got a known loss, I'm not above taking a known modest loss which I can hedge versus an unknowable, incalculable loss. That is a choice I'll take any time, just on the surface. So for that reason, I'm quite comfortable taking a known measured loss in cash for some period of time, assuming I can assign some sort of hedge to it, whether it's hard assets or gold miners or who knows what. Not recommending these, just using examples. I think that's really the choice that is really being made here, because on a valuation basis, you're going to have a hard time making the case to buy anything right now, in terms of the equity markets, and I would say the bond markets. I think to your question of what should we do, that should be guided by what is it that we need to look out for. And this doesn't keep me up at night, but if something did, it would be credit spreads and what's happening in the bond market. Bond market right now is, I've been talking about this and now for over 2 years and saying the corporate bond market is a tinderbox, an absolute tinderbox of unbelievably low quality borrowers with very little reserves. So that's what worries me. The credit quality spread between high quality debt or even real estate and low quality speculative stuff. That gap widening is going to, if this continues with such a sharp turn up in things like the 2 and 5 year note, this historically has been followed by somebody's going bust. Somebody is. How big they are and where they are, I don't know. I worry about some particular characters, but where it'll happen and when, that's of less concern to me. That the inevitability is increasing by the day.
Yeah, that's a great point. Yeah, the junk bonds risk has gone up quite a bit, and I've not followed the markets the way you have, but I think you're absolutely right that the spreads are widening. basically increasing the risk likelihood that some of these issues will default. And that's a bad news. If this picks up momentum and becomes systemic, boy, I mean, we could hit a crisis.
And that's exactly what happens is when we start to see rates rise, it increases the risk of defaults. In which case, those that are lending or willing to buy bonds demand a higher risk because of increased default risks. And so the one becomes the other. It's a self-perpetuating cycle, a self-fulfilling phenomenon. Rising, a slight concern about default risks sees people selling more than buying. That creates a heightened risk of default, which accelerates, gets into Soros's point of reflexivity. To your point about junk bonds and high yield, it's fascinating. I mean, I remember just a few months ago looking at, in fact, we spoke about it at an event that you and I were attending, where I pointed out we were getting paid, 3.8% or 4.2% on junk bonds that have that have a historic default of 7.6%. Unbelievable.
Yeah, one of the things I've learned from you, and I really love this point, is you said that the interest rate is a measure of risk, and the system has been so distorted by the fact that the interest rates on these highly speculative instruments, these junk bonds, just was too low. It's way below the real risk that they present. Specifically, with the point you made that the default rate is higher than the interest rate in those bonds, which basically turns them into negative real return investments right from the get-go.
Right. So the only person that would buy that is somebody who is sure that they can sell it before that happens.
Speculators, not investors. People who are speculating the greater fool fury.
Yes, exactly. These are certainly interesting times.
Alistair, I appreciate your wisdom. We need to do a second part of this discussion. This conversation can never finish in 30 minutes. There's so much wisdom. So I'd love to do a second episode. Let's schedule it, but bring this one to a conclusion. Appreciate your time, your wisdom. Thank you kindly for coming on the podcast. For the folks who want to reach out, maybe engage you for some consulting or whatnot, how would folks get a hold of you?
Well, that's, first of all, thank you. I always enjoy our conversations as well. It's a pleasure for me to be here. I'm routinely joked at and about by my clients that I'm black ops and they have to find me because I don't have any sort of, I don't even think I have a website. So I tend to be fairly black ops. I imagine probably the best way would be, I hate to say it, I have a modest presence on Facebook, but that's largely friends and family. But I generally probably through you, Mike, I think would be the easiest way, because I don't, it's just I'm not actively soliciting business. But again, individuals have interesting puzzles. I certainly love helping them.
Yeah, I appreciate that. I'll act as a bodyguard. If folks need to get a hold of you, they got to go through me first. So.
Great.
Thank you so much. Let's do another one. Let's record a second session when you get a chance. Schedule it, and we'd love to continue the conversation because it's a very dynamic conversation and things are changing. We'll talk again in a few weeks, and before you know, we might have a lot more different situation. Hopefully, won't get much worse, much fast, but things are moving, and unfortunately, they're moving in the wrong direction.
Yeah. Thank you, Mike. Good to be with you.
Thank you, Alistair.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.